Hello, and welcome to this month's Three Slides in 3 Minutes. Check out the gap between these two lines. The black line is the regular S&P 500, and the red line is the same 500 companies, yet weighted equally instead of weighted by size. Since 2024, as you can see, the black line has pulled way ahead. And that's not the market doing well. That's a handful of mega cap tech names doing well. The 10 biggest stocks now make up close to 40% of the entire index, up from under 20% a decade ago. So when people say the market's up, a lot of time they mean Nvidia, Apple, and a few others are up. And everyone else just came along for the ride. That's why I want you, as a client, owning the whole fairway, not just the pin or the flag. And it's exactly why we use RSP, which is the equal weight version of the S&P 500 in our client portfolios. Instead of the standard cap weighted fund, you still own all 500 companies. You just aren't making a hidden bet that seven of them will keep carrying the whole index. Here's the twist for this year. Those same mega caps have wobbled on worries about AI spending, and the average stock has actually started to catch up. The equivalent line is outperforming, the equal weight line is outperforming for the first time in a while. Now, of course, nobody knows if that broadening holds or if the big names take back the lead, but I'd watch as the bottom panel down here. That's the percentage of stocks above their 200-day moving average, and that's sitting at 66%. It's healthy, it's not stretched, which tells me this isn't a market on the edge, but it's also not cheap. The real risk for investors right now isn't a crash. It's realizing your diversified S&P 500 fund is actually a concentrated bet on seven companies. Now, the gas price spike wasn't about the summer driving season. It was about a war. And in late February, the U.S. and Israel struck Iran. And Iran responded by threatening the Strait of Hormuz, the waterway that carries a fifth or 20% of the world's oil. Oil shot past $100 a barrel, and that's your $4.50 a gallon gas, if not higher. A June peace deal brought prices down, but the fighting restarted in July and prices jumped again. Nobody knows how this ends. Both sides have reasons to want a deal, but until it's settled, expect the swings to continue. Here's what I'm watching: energy costs feeding back into inflation, lower income households absorbing this far harder than high earners, and the real risk of a full Hormuz shortdown, which would be a shock most portfolios aren't built for. I'm not chasing energy stocks on headlines. I want a bond cushion in place. Want me to check your exposure? And then finally, this chart is the whole argument for spending time in the market over trying to time getting in and out of the market. In any single year, stocks have swung as much as 52% up to down 37%. Pretty wide band. That's a coin flick most people can't stomach and don't want to. And it's so why many investors panic sell at exact wrong moments. But stretch that some money, that same amount of money over a 20-year rolling period, stocks have never lost money. Worst case was still up 6% a year, best case 18%. That's the whole game. Time doesn't reduce risk. It reduces the odds that risk shows up when you need the money. Now, bonds tell a different story. They're steadier year to year, but over 20 years, they've only ever averaged about 11% at best and 1% at worst, meaning bonds protect you from the storm, but they don't build retirement. That's why we blend the two instead of picking one. A 60-40 portfolio has averaged 9.4% a year going back to 1950, turning 100,000 into a little over 600,000 over the course of those 20 years. Versus if we had put all that money in stocks, you would have received a little over 900,000. But of course, the bonds have a lot less stomach churning along the way. The real question isn't which asset wins, it's how much of that 1 year swing can you actually survive without selling at the bottom or in a crash. So, what's your number? Thanks for watching, and if you have any questions, please let me know.